Assalamu alaikum and good evening, everyone. My name is Tanveer. I'm in Riyadh, KSA. I'm currently working in Qadin as a projects controller. We welcome all attendees and appreciate their time. It's QSAP's Quantity Surveyors Association of Pakistan. We have more than 1,600 members in more than 6 countries all over the world. We are a non-profit organization and believe in free knowledge sharing. Today is our webinar number 21, which is fourth webinar of module 1. So this module contains 5 webinars, so it's the fourth one. This module provides valuable insight and information on understanding the basic principles of project finance in public-private partnership. This is somehow a distant topic in terms of practice. So we plan it for better and deep understanding of audience. Presentation slides will be available on our LinkedIn page by tomorrow. You can visit our LinkedIn page and you can download the presentation. Video will be available on our YouTube channel. The first two video, webinar 1 and 2 video will be available soon. Our IT team is working on it. Just to mention you, it's worth mentioning that all of our events are free of charge and available for audience to gain knowledge. Before we start further, I would like to make 2 announcements. The first announcement, we will share a form in the chat box, which is required to be filled by all the attendees if they want to get attendance certificates. So please enter your name, what you want to see on your certificate, and your email ID on which you want to receive these certificates. So announcement number 2 is question will be at the end of the session. So please keep writing your questions in the chat box. We will try to cover maximum in 10 minutes and remaining will be entertained after the webinar. So now we would like to introduce our honorable speaker, Mr. Abdul Hai. Most of the you already know him because now he's with us. It is his fourth webinar. So Abdul Hai is working as design and process manager in the development department, Miyahana Company, which is one of the leading local water and wastewater developer, investor, and operator in Saudi Arabia. He brings about 19 years of diversified experience in water and wastewater treatment sector and wet utilities as a process specialist and project development lead, with proven track record of managing techno-commercial aspects. Abdul Hai has successfully delivered various development projects from inception stage to financial closing. Abdul Hai is primarily a civil engineer, holds a master degree in environmental engineering, and is PMP certified from PMI. Today, Abdul Hai will deliver the fourth lecture on the understanding the basic principle, and the subtopic is role of external advisor in project finance. So, Abdul Hai Sab, we warmly welcome to you. So it's over to you. So please, you can start. Thank you.
Okay, thank you, Tanvir. And first of all, I would like to extend my gratitude to all of you who have been attending these seminars. Of course, I'm obliged for the precious time you have been sparing to attend these webinars, as well as I would like to thank QSAP Forum to provide a platform of communication among the attendees and the speaker. Thanks to you all. So, as we are already aware, this is the fourth webinar of its series that we have organized from past couple of months. So, this is the fourth of its series, and the topic is very interesting. And little is known about the concepts of the project finance, although there have been many specialized companies and there have been many specialized people, but the formulation of this course have been made such a way that even a common audience can easily understand and get benefit from this. So, coming to our modules, as we have explained a few times ago, we are planning to conduct 15 webinars, and each webinar will be splitted in 3 modules. Module 1 will comprise of 5 set of webinars, Module 2 again 5, and Module 3 again 5. So as of now, we are on the verge of completion of Module 1, where we have delivered lecture number 1, where we discussed some concepts of financing. We already have delivered lecture number 2. The third lecture already that we had made a few weeks ago about the role of external advisor, and because this is a very crucial subject, we decided to convert this lecture into 2 lectures. So one of that was delivered a couple of weeks ago, and the second of its series is being delivered today. So today we are again going to continue with our role of external advisors, and then at the end, the 5th webinar, we will talk about the tender process. Before I move on to my main content, it would always be good to refresh our mind with what we have learned, what we have discussed in past. So I will quickly recap webinar number 1, webinar number 2, and webinar number 3 before I go to my webinar number 4. So in webinar number 4, we had an extensive discussion on the concept of project finance, where we had clearly mentioned that project finance is basically a non-recourse type of financing, and sponsors, they normally don't give any guarantee of repayment of the debt, and all the money that is being retrieved by the lenders is primarily from the cash flows that are being generated by the operating costs, by the operation of the plant, and lenders can only retrieve their money from the cash flow, and they don't have any other thing as a collateral. Then we also discussed in detail that as a project finance, once we are dealing with a public-private partnership, the sponsors would like to go with a high level of leverages. It means that more debt would be desired from the banks. And why more debt will be desired from the banks? Because debt will be cheaper than the equity or the amount of money that investors are going to inject. So going with high leverage or high gearing ratio will improve the return of investors. And if there is a government client, they will also be willing to go with a high leverage, because in turn this will reduce the cost of their product and the commodity pricing will become lower. We also debated on the use of the finance, why it should be used. Some of the reasons that are in front of you, that parties with different financial strengths, they can work together, because the concept of project finance involves significant due diligence by the lenders, and so many parties are keeping a watch on what is happening in various contractual terminologies. This makes the project more transparent, and this ensures that all risks are transferred to those who can best manage it. And one key advantage for developing countries, that if you will use the project finance, most of the banks are international banks, and this provides an opportunity for additional investment that public sector might not have otherwise. We also debated different type of the contractual structures in project finance. One of them was an offtake contract. In an offtake contract, we debated that offtake contract, there is one input, which will be a raw input, will process through a certain project, and after the processing, there will be a refined output, and this refined output will be procured by an off-taker or a contracting agency. So this will be an off-take contract. We also debated on another type of the financial structure where there's a concession, and concession means that instead of contracting agencies paying the price for the project, they normally charge it from the public, from the sector, from the public sector, where the people, they pay for its reuse. And one of the examples that we discussed was the tolls. that will be received by the sponsor in order to provide the services. We also had an eye on bottlenecks of the project finance, where we said not everything is good. There are certain key bottlenecks which were discussed in our webinar number one. One of them was that lenders, they keep themselves above everything, and any payment will first be received by the lenders, and whatever is left, the remainder will go to the sponsors. So lenders remain priority. We also had been discussing in our previous webinars that it's a very slow process and it can take time and it can take a lot of money. And also because lenders, they control the overall process, so sponsors, they would have restricted decision-making ability on these type of projects. Similarly, in webinar number two, we discussed primarily on the modes of financing, what are the sources of funding, and what is a typical life of a project in a project finance. The typical source of funding that we debated in the past were one of the source, which was bank, and we discussed different type of the banks who can source the funds. Among them were commercial banks, development banks, export credit agencies, and commercial banks were the most common lenders. And our overall sections, which we will discuss from now and that we discussed previously, will around about those commercial banks. And we had mentioned that sometimes when the loans quantity becomes large enough, it's not easy for one bank to fund the whole project. So they make a club and then they nominate an agent bank, and this agent bank acts as an intermediator on behalf of project company and the banks. We also discussed an alternative source of funding, that was issuance of the bonds. And what was the advantage in issuance of the bonds? That who will buy the bonds, they will be paid with periodic coupons, and the money will be returned at the end of the maturity of the period. And we also had discussed that these are tradable instruments and they can go from one hand to another hand. And in order to structure the deal, when bonds are involved, typically an investment bank is appointed, and this investment banks performs a lot of assistance in structuring the overall project. And in order for the sponsors to engage with the commercial banks, typically a preliminary information memorandum is issued, and this preliminary information memorandum summarizes the project with all key elements involved. And through this preliminary information memorandum, the banks are invited to bid to underwrite the loan. And the banks who have interest in underwriting the loan, they provide in return a letter of intent. And once the deal is finalized and sponsors want to go with a specific bank, sponsors issue a mandate letter specifying the exclusivity of the bank for this project. And once an exclusivity is made, typically the terms which will form the basis of funding are agreed, and they are agreed in terms of a term sheet that is drawn, and this term sheet forms the basis of the finance that will be provided by the banks to the sponsors or to the project. We also discussed about the typical life cycle of a project in a project finance, where we divided the overall life of the project in three core areas. One was the development phase, the construction phase, and operation phase. So development phase is the phase where most of the efforts are made by the sponsors. And this is a phase where the lenders they inject the money into the project, and as well as sponsors they make their equity available for the project company to withdraw. And the end of this cycle, we refer this to as a financial close. And once the financial close happens, the money is ready to be withdrawn, and then it follows a construction phase where the debt is withdrawn, a project is built, tested, and is made ready for operation. So end of this construction phase is typically called a commercial operation date or project commercial operation date. And once the project commercial operation date is achieved, then the project company starts operating the project and produces the cash flows from the operations. And after managing the operational costs, the remainder is being paid to the lenders and investors. We also had discussed that when more than one sponsor they come in and they formulate a specific joint venture to conduct that project, the roles and responsibilities must be defined among those partners through a formal document that is called a joint development agreement. And once the project financial close is achieved, this joint agreement takes is replaced by a shareholder agreement where this joint development agreement is superseded by a shareholder agreement, and those sponsors thereupon become the shareholder of that project company and they enjoy the dividends from that project company. Webinar number 3, we started discussing the role of external advisors. One of the questions that we answered was why to hire those external advisors. And we mentioned several points that helps sponsors to justify hiring of the external advisors. One of the key reasons for the sponsor to hire an external advisor was the nature or the availability of projects in the market. So for those countries where project finance projects are limited in number, it does not make any sense for sponsors to keep employing a team for a longer period of time when they have to deal with only 1 or 2 projects in a year. The second reason, we said when a sponsor is looking for a diversified portfolio and wants to develop a wider pipeline of project, no one will have the ability to be a part of the team which is multidimensional and can successfully steer the process. So they have to hire external advisors. And the third reason, that once you hire the project advisors, it enhances the credibility in terms of lenders, and as well as it expedites the overall process. And as we have seen that many times we debated that the project finance is a very slow process and it takes a lot of time. And until unless it is in the safe hands of experienced professionals, it will delay further, and the engagement of professionals who are experienced in advisory services for these type of deals, once we engage them, it will help to expedite the process and make the overall process successful. There were many advisory services that would be required over the course of financial close, during the construction and during the operation. One of the key area where sponsors normally look for an advisory services is the services of a legal advisor. And legal advisors are typically the most important part of the advisory services, as they help to structure the project and create a system where risks and the cash flows are interlinked, and they ensure that all risks are mitigated in a way that cash flows are more or less streamlined and they can be obtained in future with a reasonable expectation, and they can be distributed as per the financial model and the assumption that were made before the financial close. So the role of legal advisors was split in two major components. One was before the financial close, and this before the financial close was a pre-bid and a post-bid role. During the pre-bidding stage, once the sponsors come in and they form a joint venture, they help in establishing those development agreements. They look at the documents which are received from the contracting agencies. They clarify things with the clients and they submit some pre-submission markups to mention the reservations in front of the client and to resolve it. And since there are many parties involved where the sponsors would be dealing, so legal advisors on the behalf of sponsors, they negotiate the term sheets with the O&M contractors, with the EPC contractors, and other relevant parties. One crucial thing which legal advisors must have to perform once they are engaged in a project finance deal is that they have to develop a due diligence report where they are obliged to review the overall contracts and find out the risks that could impede the process of achieving the forecasted income. So they divide the risk in three core categories: red being the highest risk, amber being the medium level of risk, and green being a risk that is either mitigated or transferred to someone. Similarly, once the preferred bidder is announced and the sponsor moves to financial close, their role is again very crucial. Whatever markups or delegations they have placed in front of contracting agency, they negotiate on behalf of sponsors. All contracts and agreements, negotiations, they happen through legal advisors. And once the project company is formed at the end of the financial close, any permits or any approvals that are required to establish the project company are being dealt by legal advisors. And similarly, once the project goes in operation, they give a manual of contract in a simplified form mentioning the operational team, their contractual obligations, and how they would protect themselves in case of any disputes. Then another key element in advisory was the financial advisory, and the financial advisory services are also required by the sponsors, and their role is to ensure primarily to establish the structure of the project in such a way that it becomes acceptable to the banking market. So the financial advisors, they work closely with the lenders and ensures that any apprehensions or reservations those banks have, they respond to their queries, and whatever are their demands, legitimate demands, are being placed in the financial model and in the contractual agreement so that the banks are willing to lend the money to the project. They have some typical rules. They go to the market by issuing a preliminary information memorandum. They negotiate with the prospective lenders and they negotiate with them on the competitive terms and conditions for the project financing. And they as well as advise sponsors on the sources of the financing and what could be the potential and optimum financing strategy that could help them optimize their tariff. And similarly, they work closely in the models and then they finalize any arrangements which are required to ensure the commitment from the banks in terms of the senior debt or equity bridge loans which are being obtained from the banks on behalf of sponsors. Post bid, what they do, again, they clarify any queries requested by the contracting agencies. They refine the financial models. They negotiate and finalize any financing documents, as well as they assist sponsors to a greater extent so that all the conditions which are precedent to achieve the financial close, they are achieved. And they execute and negotiate on behalf of sponsors any documents which are required for the hedging. So we have discussed all these things in our previous presentations, and we will continue with a similar one. And the remainder of the advisory services that we had left in our previous lecture, we will discuss it today. Apart from the legal advisors and the financial advisors, there are three more crucial advisory services that will be required either by the lender or by sponsor. One of the advisory services is the service of a technical advisor or an engineering advisor. Lenders would like to have an engineering advisor, and sometimes sponsors might like to have a technical advisor to facilitate them communicate with the APC contractor. There is another crucial advisory services which is a must in front of lenders, and that is engaging an insurance advisor. And the third one is engaging an environmental advisor, which is sometimes stipulated by law and is a mandatory requirement of government agencies prior to construction of any project. So we'll also discuss about the fee structure of these advisory services and what are the typical development costs that are required in the overall process of development. So here we go with our discussion about lenders engineering advisor. So now again the question is that why to hire them? And the rationale to hire them by the lenders is to have a sound opinion on the technical feasibility of the project. We need to understand something here that when it comes to the sponsors, they are engaged with the clients. They have been reviewing all the technical and engineering documents clearly. So they have a very clear picture of what they are going to develop. All the construction and engineering features are obviously clear to them. But this might not be the case for lenders. So once the project moves to a financial close, lenders are blind in terms of the technical aspects, and that's where they need a specialized professional to help them evaluate the technicalities of the project. And then, based on the inputs of the engineering advisor, they decide whether they should proceed with lending that project or not. As we discussed, no bank has the technical expertise on their staff. They are mostly financial guys. They have a strong background in the finances, but they'll know a little about the technicalities of the project. So they essentially require an engineering advisor who should provide an opinion on the feasibility of the project, who must be able to evaluate the solutions given by the sponsors and the APC contractors and control them, and most importantly, safeguard the money of the lenders. So typically, lenders see those engineering advisors as the ears and eyes for them who safeguard their interests in terms of the technicalities of the project. So what technical advisors typically do in that case? We discussed previously that legal advisors, their one of the key role is to produce a due diligence report to identify the risks. Lenders' technical advisors typically have a similar sort of role, but this is more onto the technical aspects. So they do produce a due diligence report, which critically looks at the technical aspects of the project deal, and then they are the one who verify that all the technical variables which have been used to build that project and design that project are acceptable, and all those are properly reflected in the financial model, and whatever the costs being put forth by the sponsors are reasonable and align with the market precedents. So during this phase of due diligence, they help the lenders in many different ways. I will subdivide them in four core areas where they are facilitating the lenders. First of all, they develop a due diligence report. And once the project is being accepted by the banks and moves on to the construction, they facilitate those lenders by giving a construction phase monitoring services. And once the construction is over and the plant comes into operation, they facilitate their banks in evaluating the performances of that project. And then during the operational phase, they keep a close eye on the operations to ensure that lenders' interests are not violated. So, what is happening basically? The due diligence that is being envisaged by lender's technical advisor is to identify all the critical points that could be crucial for the technology and to identify those areas where there could be technical issues. So, the report that they are developing for their lenders provides an opinion on many issues. And what are those issues typically? One of the issues they look into that whether the sponsors who are bringing this project they are selecting a technology that is reliable and mature enough. So those technologies which are state of the art technologies sometimes they may be pretty good and they may be wonderful, but since they are not tested in the market and they have not an established performance over a longer period of time, lenders would tend to ignore those solutions and will not go forward. So, lenders advisors, on the behalf of lenders, they look at the technological solution and they ensure that these technologies have been in place and they have been in practice for a longer period of time. And once they come in operation, they can operate over a longer run. Because we discussed project finance, to recover the money, it would be better to stretch the overall life cycle and which can span over 20 to 30 years. This is one thing. Lenders advisors, on behalf of lenders, they also look critically on the assumptions in terms of design of the technology that has been considered. They look at the inputs and they look at the outputs, and then they advise lenders whether the EPC contractor who has been designing the system or the sponsors who have been considering certain assumptions for the design are adequate and realistic. As well as they also advise lenders on the assumptions made in the financial model account for the cash flows that could be generated over a longer term. So there will be a sponsored sales plan, which are basically the cash flows in the model, where they project that they will be getting an X amount of money over the period of time. So they look closely whether the expectations or projections made by sponsors in terms of the pricing and in terms of the technical assumptions are realistic and reasonable. As well as lenders are specifically concerned with the risks involved in the project. So they would like someone to technically analyze whether the change in the inputs over 20 or 25 years period of time would have any harmful impact on the operation of the plant or in turn on the cash flows being generated and their ability to pay it back to the lenders. So lenders, one of the core exercise that they do as a part of their due diligence reporting is they analyze the vulnerability of the project and the risks that could be involved during the operation of that project, and then they will advise that how these kind of risks will be covered. So during this course, they might ask the sponsor's financial advisors to run many sensitivity analysis by variation of many variables and what are the outputs. And this sensitivity analysis is used to find out whether lenders' interests are protected over a larger variation of those variables, and whether lenders they have enough protection that even if there is a variation in the operational parameters, lenders would still be getting their money. So this sensitivity analysis is being also requested by lenders technical advisor to the financial modelers of the sponsors to evaluate the degree of cash flows robustness and whether a sustainable cash flow could be achieved over the project life. As well as they also look at the financial assumptions made for the construction and the management of the plant. So lenders would not like to fund a project who is underpriced or who is exceptionally overpriced, giving sponsors a windfall gains. They would like to know whether the projections of withdrawing the cash during the construction period make sense or in line with the construction program being issued by an EPC contractor. And those advisors also look on the contingencies that are being assumed by the sponsors in case the cost get overrun. So they have a very close eye on all of this, and they even look at the schedules made by the EPC contractor and the startup of the business operations, and they validate whether these timelines are reasonable or not. Because if the project gets into delay, it means your financial close or your commercial operation date will delay, and it will inevitably impact the cash flows that would be delayed because of delay in the construction timeline. As well as they look at the framework of construction staffing and the operational staffing. They validate whether during the operation, the project company is going to deploy enough resources and enough budget that could help the project. So all of these things which lenders are lacking because of their financial background are being compensated by lenders technical advisor. So they do a lot of work for the lenders advisors and they remain a headache for the sponsors. And those sponsors would like to resolve all these issues as soon as possible, because if lenders technical advisors raise some concerns on the technicality of the project, then lenders would definitely have an opinion of their advisor and they will listen more to them. Now coming back to the construction phase, what lenders do is that they develop these advisors as a project manager for them, who will monitor the progress made during the construction. And then lenders would like to have a periodic reports from these technical advisors, and many things will be required by lenders that their advisor certify, and based on the certification, they give a go ahead to the sponsors to withdraw any money. So what they do basically during the construction phase, first of all, the lender's technical advisor, they confirm to the lenders that all conditions which are required for the fulfillment of the financial close are achieved. During the construction time, they review the progress reports, which are typically issued by the project company, and they look at the costs and timing of delivery of those project activities, the milestones. They also review the request for disbursement. We need to emphasize one thing here, that sponsors cannot, at their wish, issue money to the EPC contractors. So this is a typical cycle that once an EPC contractor raises an invoice, this invoice is being reviewed by the sponsor or sponsor's advisor and is duly signed and stamped. Then it goes to the lender's technical advisors who verifies it. And then once this verification is done, he certifies to their lenders that the payment should be released because all things which are related for certain milestone to be achieved, they are achieved. So lenders would act upon advice of their advisor to release any disbursement request which came from the project company or an EPC contractor. And similarly, if there are any variation orders, they will have their key role in giving a comfort to their banks. Okay, so they also have a control and review the actual and cumulative spends against the forecast. And if there are any overruns or there are any possibilities of potential overruns that may happen in future, they would like to raise this to their banks to tell them and to take preliminary actions before such potential overruns happen. And at the end, project company cannot get any money to issue this to an EPC contractor until unless lender's technical advisor they issue a drawdown certificate. And this comes after checking all invoices received from the project company, and then they compare them with the contractually agreed milestones and the models. And then once everything is justified and is aligned, then they issue a drawdown certificate based on what lenders release the money. And then once the works are complete, the lender's technical advisor typically look at all the completion works and then they issue a works completion certificate to ensure that the project has been successfully delivered, ready to be operated, and all punch list or snag lists which were a part of EPC contractors' scope, they have been resolved. One key area where lenders would like to have their advisors engaged in is during the performance acceptance of the plant. So once the construction phase is over, the plant has to undergo certain performance tests. And these performance tests may span on multiple subsections. So what their role is basically, they review and evaluate all the procedures and any shortcomings, if they are in those plans, they identify those and then they evaluate and then they approve it prior it goes to any performance testing. And then they closely participate in those acceptance testings and verify whether the plant, once it is running under full capacity, is performing in accordance with the output requirements that were agreed before the construction took place. And then they look at the results, they analyze them, and those results should not be the results from the sponsors or project company by themselves. They typically demand a third party organization to be hired who will make all those tests. And once this third party certifies to the lender's technical advisor, then they give confirmation to their banks that everything is on track and in line with the contractual requirements. So they issue provisional acceptance certificates, as well as they issue the final acceptance certificates once each and everything is made. So this is their role. We should not underestimate lenders' technical advisors, because lenders heavily rely on them during the, the construction phase, as well as before the financial close. And whatever is their opinion becomes the opinion of the lender, and sponsors must have to respond to all queries raised by lenders' technical advisors. Now, when it comes to the operation, still, audit company's life is not simplified. Lenders would like to have, again, a close watch on the operational management of the project, and how they keep a watch by consistently monitoring the operation activities of that plant. So this LTA, which is lender's technical advisor, they regularly visit the site. So one of their key roles during the operational phase is to have a periodic site inspection and to assess whether the operational administration is in accordance with the management services that were agreed. And if there are any deviations, they would like to rectify those and highlight these to their lenders. Another thing, they will analyze the historical operation. So it's an obligation of the project company to keep sharing the historical operational information and maintenance records, logbooks, and any operational data which is being prepared by the project company for the management and operation of the plant to the lenders, so that lenders can analyze the performance of the plants, and if there are any hiccups or if there are any issues that might happen in near future, they can analyze and report to the lenders, and lenders could jump in to solve those issues. As well as they keep a check on the costs, the operational costs, the budget that have been established by the project company is being spent or not. Any maintenance activities, they are in line with the original equipment manufacturers. The schedules are there, so they have a close eye, and they maintain this check on the project company. And the fourth, this is one of their obligation to issue the periodic reports to the banks, so that banks will have a fair idea of the operation, and they, in those reports, they basically do valuations of the technical variables, and they ensure their lenders that the way product company is performing and is operating the plant is sufficient to continue generating the cash flows without any major failures of the plant. So lenders technical advisors, they help out lenders before the financial close by giving a due diligence report. Then they keep engaged with lenders during the construction period by certifying all the drawdowns that would be required to be made by the lenders, and during the operation, they issue periodic reports to the lenders to ensure that everything is going as per planned operational activities. So here we have discussed the role of technical advisors. Now comes another crucial role, which is engagement of an insurance advisor. We had been discussing one thing in the past, that lenders would not like to have risks which are not mitigated or delegated. So what they do is, one of the tool that is being used by lenders to mitigate any residual risks is to put in place sufficient insurances in the contract and in the project. So what they would like to do is to hire the services of a professional insurance advisors who will act on their behalf and will ensure that the risks are being mitigated and adequate insurance provisions have been made in the contracts, so we need to understand here that project finance is a highly leveraged job. So this highly leveraged transaction, banks are going to spend majority of the money. That could be 80% of the cost of the whole project. So to protect their money and to ensure there are always cash flows, and if there are any unforeseen events, they are protected. So particularly those banks are very sensitive to the risks involved. And then as a course of this mitigation, they often put in place an effective and robust insurance program. And once they have a concern that the insurance program which has been placed by the project company is not sufficient, they can even back out from the project. So the bankability of that project and the insurance program put in place makes a very close link in structuring the financial deal. So what we can say that this insurance program is an indispensable and mandatory part of lender security package, whereby they would allocate any risks which they cannot mitigate or transfer through a potential insurance program. Now what happens? Financial advisor and insurance advisors, they work closely with each other. So financial advisor gets opinion from various independent advisors who are engaged, and then they develop a risk register, and all possible risks are defined, which may have an impact on the outcome of the project. So what are the probabilities of those risks? What is the impact going to happen? And what is the likelihood? All of them are discussed and debated. Then this risk matrix goes to an insurance advisor who is specialized at insurance advisory services. And this insurance advisor evaluates the insurability of those risks. And once he evaluates the insurability of those risks, then he find out or he establishes what kind of suitable insurance programs should be placed and sourced from the market that could mitigate the risk of the lenders. So, not to forget, the risks are being mitigated to greater extent by putting in place an insurance program, and this is a very expensive add-on. And lenders, their requirements in terms of the insurance are very demanding. And that's why the insurance costs, they go high. So it's very important that once the sponsors, they develop their project costs and they put in financial model, any insurances which are required by the lenders are carefully assessed and they are structured in a way that satisfied the lenders both during the construction of the project as well as during the operation of the project. So, in what phases lenders would typically require insurances to be placed? So, we will divide them in two phases. One phase is the construction phase, and one phase is the operational phase. So, lenders would require an insurance program to be sourced during the construction of the project, as well as they want to have annual insurance programs during the operation of the project. So, what are those construction phase insurances? Here, we need to differentiate something. In a typical construction contract or in a normal EPC contract, the liability of having an insurance program remains on the EPC contractor. And EPC contractor in a conventional construction project ranges all those main insurances and includes these insurances as a part of the contract price. And this is logical from the perspective of a typical construction project because EPC contractor is at a risk of loss and he has to ensure in case if there is something destroyed. So contractor has to come in and through his insurance has to require and acquire the proceeds where he can use to replace it. But in a project finance, this is not the case. Typically, in a project finance, most of the insurances they are being placed by a project company. Why? We will answer this question here. One of the key reasons that lenders would not like EPC contractors to have these insurances is delay that could be caused by the construction activity. Lenders typically require an insurance which is called a delay in startup insurance so that in case if project goes into delay, the losses they are incurring as a result of this delay are being recovered through a potential insurance program. And why an insurance company will give this insurance to an EPC contractor who is a party and who can intentionally delay this project to get those insurances proceeds. Another reason construction contractor would like to keep their costs minimum. So what this construction contractor will do, he will buy an insurance which will be cheaper. And how he will secure this, that he will have a less coverage and a less comprehensive coverage would be against the lender's requirement who want the risks to be fully mitigated and they would like to have on another hand a very comprehensive coverage. And if they leave this to a construction contractor, this could be a potential bottleneck among the lenders, project company, and construction subcontractors. And one crucial area why EPC contractors will not have insurances as a part of his package is because lenders they wish to control the overall project. So if there is any problem with the project, so any proceeds which are coming from the insurance should not go to anyone with the exception of lenders. So what does it mean that lenders, as a part of their control, they want the project company to have an insurance program, and if there is an issue or there is any risk materialized, insurance company would pay this amount to the project company from where lenders will have a full control in the distribution of those proceeds. In addition, there are many specific requirements which are only specific to the lenders. And these are called bankers' clauses. For example, they might want to have other parties to be co-insured or additional insured without paying any premium. And of course, once you will have additional insured parties or more stakeholders in the insurance program, this is going to increase the cost. So unlike a typical construction contract, an EPC contractor is required to maintain only those insurances which are related to a typical construction project. But when it comes to the project finance, lenders would require a more comprehensive insurance program, and they would like this insurance program to be parked under a project company's name. And the project company may have to acquire all these insurances. Now, what kind of those insurances would be required by the lenders or project company? We have discussed that there are two kinds of project insurances. One is during the construction phase and during the operation phase. So the main insurances that are required by the lenders or in a typical public-private partnership deal are far different than a typical construction project. So one of the insurance requirement is to have a construction all risk insurance. So this is a very comprehensive kind of insurance, and it covers any physical loss or damage to the works, materials, any force majeures such as fire, natural disaster, act of war, form part of this all risk insurance. Any issues coming from the defective design or workmanship are also covered under this construction all risk insurance, and any third party liabilities are also coming under this one insurance. So this is quite a comprehensive insurance which covers all risks which can arise during the construction time. And as we discussed in our last slide, that insurance is also placed for delay in startup. Because if there is a delay in startup, product company is at loss of revenue. And this insurance will compensate any additional costs that would be incurred by the project company. Employees' liability is also being maintained by the project company. Now, one more insurance that typically makes part of lender's insurance package is marine cargo insurance. Because in these international projects, many of the equipment they might come from outside the country, so and they will pass through marine. So there are potential chances that there could be some damage during the transportation or delivery. So they would like to have marine cargo insurance, as well as if there is a delay in the marine cargo, again, their businesses are interrupted. And this delay in startup because of the marine cargo not being delivered on time must also be insured. In case of any sabotage and terrorism, the product company must be indemnified. And another insurance in case if during operation or construction, if there are any hidden pollution or hazardous elements found on the construction site, there must be adequate protection in terms of the insurance. So you can see in the project finance, the cost of insurance is quite hefty. So the amounts goes high, but these are mandatory requirements of lenders and they must be maintained in any construction project. Now, when it goes to operational insurance, we have the first one, property all damage risks. This is similar to construction all risks. During the operation, if there is any damage to the property or if there is any breakdown of the property, then all risks, all damages which are coming as a result of this breakdown or damage of the component of the project are being insured under property damage all risks. One unique insurance that is specific to the project finance is business interruption insurance. So during the project, if there is some interruption in the operation of the project, lenders would not be able to have their cash. So this limitation of cash flow is being compensated by putting in place a business interruption insurance. And this protects basically the project's liability to generate the financial return and any losses that are inherent because of this interruption of the process. So employees' liability is one of the typical requirements. Sabotage and terrorism remains one of the typical requirements. Environmental remains one of the typical requirements. One thing we need to discuss are the deductibles. Insurance, whenever we hire an insurance service, it has a certain amount of deductible defined in the insurance package. So what happens to this? If your deductible is high, the cost of insurance goes low. So product company would like to make the deductibles quite low. So what is the intention of product company? The intention of the product company is to reduce the cost. And how they can reduce the cost is that the cost of the insurance or the premium they are going to pay must be smaller. And the insurance companies, how this insurance company will make the premium smaller once you will have higher deductibles. So product company would like to have relatively large deductibles to cut down the premium costs. This is against the lenders because the lenders would try to reduce the risk to the lowest possible level, and by this way they will like to have maximum deductibles. So this is a tug of war that happens between the product company and the lenders, and insurance advisors is one of the key stakeholder to mediate between the product company and lenders requirement to reach to a reasonable consensus. Okay, so what they typically do is once the financial close is going to achieve, before that financial close, they issue a preliminary insurance report. And in this insurance report, basically they analyze the contractual document and they identify the types of insurances being allocated for that specific projects and whether these insurances which have been allocated can cover the insurable risks or not. And then, of course, there must be a term sheet between potential insurance broker or an insurance company and product company, which should form the basis of later procurement of that insurance program. So they prepare such contractual term sheets, as well as once the project goes into the construction, as one of the condition required by the lenders before they issue any money for the drawdown as a part of their condition, they advise insurance advisor to check whether the insurance program has been placed in accordance with the financial documentation or not. As well as they would like the insurance advisor to look on the credibility of those insurance companies who are underwriting the insurance for them. And finally, the insurance advisors confirms to the lenders that the insurance program which has been placed by the product company is in conformity with the findings that he had presented as a part of their preliminary insurance report. And once the project goes into operation, similar activities are repeated. So the insurance program is validated against the documentation of the project, against they look at the ratings of those companies who are underwriting these insurance, and they also ascertain that during the operational period, this insurance program is in conformity with what had been agreed with the lenders. So, role of environmental advisors. I'm a bit conscious of time, so I will try to expedite a bit now. So, the role of an environmental advisor is very crucial, and many projects they require before their construction that there must be some environmental study to be conducted before a construction could take place, as well as many international banks they have signed on an equator principles. So they being this signatory on these equator principles, which are actually 10 equator principles, and many of them relate to the environmental preservation, they pledge among themselves that they will not finance any project that is not compliant with those equator principles. So one of the key requirements, which is also an obligation in many countries by law, that once you start a project, you have to conduct an environmental and social impact study. And this study is made to ensure that necessary construction permits and operation permits are obtained by the project company. So, what is the intent of having this impact assessment is to look at the impact of the construction on the environment, if there are any emissions into the atmosphere, or if there are any discharges to the water bodies or disposable of waste, are they going to be handled properly, or how these emissions and disposals will be managed, and what are the long-term impacts of this project on the local community or the natural environment. So once all these issues are resolved and mitigated and necessary plans are put in place, then an environmental permit is issued by regulatory authorities. In the case of Kingdom of Saudi Arabia, this is the NCEC. Okay, and this NCEC typically issues the environmental permit for the construction and then environmental permit for the operation. So what an ESIA advisor activities are in the development stage, his role is to conduct an ESIA, and as a part of the ESIA, he has to submit a screening report to the NCEC and then a scoping report that what this ESIA would be covering. And once these scoping and reports are approved by NCEC, a preliminary ESIA report is being submitted, which follows a conditional construction permit. And once the conditional permit is obtained, the construction starts. And during the construction, they monitor and evaluate the action plans which are being recommended in the ESIA, and they maintain an environmental register. And then at the end of the construction phase, they apply on behalf of the project company for an operational permit. And during the operational permit, they continue monitoring and evaluating the action plans and maintaining the environmental register. And then they apply for renewal of these operational permits after every 3 years. Now, one thing we have discussed in detail the roles of advisors. Now the question is how they should be paid. One thing we need to understand here, the sponsors are injecting significant amount of advisory services, and this amount of money that is being injected by them, if the project is lost, they are not going to get it. So they will try to keep the investment on those advisory services as minimum as possible. So in many cases, once the advisors they are hired, they are typically paid by a combination of two core payments. One is called a retainer fees and one is called a success fees. So both of these, they form the part of the advisory services. So what is the retainer fees? The retainer fees is basically the time consumed by the advisory services and their compensation for the time they have spent. Of course, the advisors at the pre-bidding stage, they have to prepare a lot of things for both lenders and sponsors, and they might have to spend significant amount of time. So this retainer fees is paid a Thanksgiving fees to the analyst's time that he has spent on this. But the issue is this, the retainer fees may not cover the overall cost of the company, cost of that advisory services. And at the same time, lenders or sponsors would not like to pay because the project has not yet been secured and reached the financial close. So there is a midway, and the midway is this, that the overall fees is split into a retainer fees that is paid, and this retainer fees is paid before the financial close to cover some of the expenses and the time being spent by the advisor, and the rest is paid once the project reaches to the financial close. So this is a lump sum amount of money that if the project goes into the financial close, this success fees is paid to those advisors, and it can be either a percentage of the debt value or a fixed amount. It depends on how sponsors they negotiate with these advisors. So now the final presentation is the development costs. As we have heard that before the financial close, there are a lot of advisory services, there is a lot of time being spent, there are travels, so many things. They must be captured somewhere in the financial model, and these costs are captured through a term called development cost. So, what are these development costs? These development costs are the costs that are being incurred by sponsors before the financial close. So, any cost which is being paid by the sponsors before the financial closing, these are clubbed under a bundle of development costs. And one beauty of the project finance is this, that if the sponsors they reach to the financial close, the nature and the type of the project financing allows them to reimburse all these costs at financial close. In addition to that, sponsors they have also a prerogative to charge a fees because they have been developing the project and they are putting in place a lot of efforts. So the initiative is coming from them. So on the costs, they also have a prerogative to charge an initial fees, which sometimes is called a development fees or a success fees. And once there is a financial close, this becomes an upfront profit that is being withdrawn by the sponsors upon the financial close. So we need to understand that project finance is particularly expensive due to the higher number of consultants being engaged for the development phase. And the cost of sponsors advisors, lenders advisors, they are a sizable component of the overall costs. On top of that are sponsors overheads, travel costs. So they're likely to be significant. So all these costs are being recovered at the financial close along with the success fees by the sponsors, and this becomes an upfront profit for them. One question that we should also ask, what about the contracting authority or an off-taker? Because off-taker or a contracting authority is also using similar kind of advisors for themselves. They might have technical advisor, a legal advisor, other sort of advisors, and their cost would also be substantial. And these government agencies typically don't have the budget to cover these costs. So what they do in this case, they request as a part of their tender that whenever there is a financial close achieved by a winning bidder, the winning bidder must pay as a part of the financial close all the development costs which are being incurred by the contracting authorities. So during any bidding stage, they define the amount in millions that should be kept in the financial model as a development cost for the contracting authority. So once the project goes into the financial close, there are two withdrawable elements. One is the development cost incurred by the sponsor along with the success fees. And the second is the development cost disbursement to the contracting authority, which he has also paid during the course of developing all their tenders and negotiating with the sponsors. So this lump sum development cost of contracting authorities, whenever there is a financial close or the first withdrawal down, this has been paid accordingly. So with this, we have closed our lecture. So I would go back to my host.
Thank you very much, Abdul Hai, for informative and engaging presentation. So we have few questions. Let's take those questions. The first question is from Mudassar Iqbal. He is asking, what is the difference between CAR and property damage all risk insurance?
Okay.
Risk
So,
insurance.
right. So property damage is typically covered in the in the CAR. So once we had a discussion on the CAR, one of the core risk that we had discussed was the damage to the assets of the project. So we have two risks: one, damage of the assets of the project during the construction stage, and the other one is damage to the assets of the project during the operation stage. So when it comes the construction, then this is being covered by construction all risk insurances. So you can consider that this damage or physical loss to the material or the equipment at the project site is one component which is bundled up in construction all risk insurance.
So we'll go to the next question. Next question is from Ghulam Dastagir. He is asking how the project company should deal additional time and cost impact due to change order and delay claims without having additional interest from lenders.
So one of the beauty of this project is that these are ring-fenced projects. So the EPC contractor's costs are not going to change unless there is a material deviation being requested by sponsors or an off-taker. So whatever is the cost being incurred are ring-fenced, and this is where the lenders would like to have a lump sum cost in the project. So if there are any delays, there are LDs being paid by the EPC contractor, but they will not be covered because they may not provide the amount of compensation that is being imposed by delay LDs. So here is where that project company will charge the EPC contractor with delay LDs, and as well as, because this delay has happened, so there is one more insurance which is delay in startup, and they will also claim through their insurance that the remuneration or the amount of money which they have lost because of this delay must be paid by the insurance as a proceed. So lenders are protected by two ends. One, through the delay LDs being charged on the APC contractor, and the APC contractor does not have any right to change their costs, as well as lenders will go to the insurance companies to claim delay in startup insurance and get proceeds from their end.
Thank you. Abdul Hisab, there is another question from Mudassir Iqbal. Basically, it's a part two of his previous question. Whether DAR insurance is part of CR insurance or not.
Okay, to clarify, the construction all risk insurance, it has four main components. One component that covers loss or damage of material and equipment. Second, it covers any damages resulting from the force majeure events. Third, it covers any damages resulting from the defective designs. Fourth, it covers third-party liabilities. This insurance is quite a comprehensive insurance, and you can imagine that any insurances which are typical would make part of this construction all risk insurance. That's why it is construction all risk insurance.
Thank you, Abdul Hisab. Now our time is going to end. And we have, I think, there is no more question also. So thank you very much, Abdul Hisab, for your informative and engaging presentation. We appreciate the time and effort you took to share your knowledge with us. And thank you, our audience, for spending the time. So next webinar date will be announced soon, and hopefully it will be next year, not this year. So till then,
Okay.
take care. Bye. Thank you.
Okay, thank you very much for all of you for spending your time. I'm really obliged for your kind attendance to this presentation. Okay, bye-bye. See you soon.
Bye bye. Thank you.